Aloha, everybody. We are Retoro Capital Investments, and we're excited today to introduce ourselves, introduce some of the benefits of working with us, and how we can help you grow your wealth. We are a real estate private lending and equity fund, and we work with accredited investors, and we do lending, which gives 10 to 12% annual returns. We are customizable diversification fund, and we like to have your money working hard for you and not the other way around. So with that, we'll start with our leadership team and my lovely partners, Chris Borden. Could start the show.
Thank you. I'm glad that I'm lovely now. Prior to coming on, I was not so lovely. So. But thanks for joining us. If you guys are out there and if you guys are listening later, thanks for being here. Thanks for spending the time. Hopefully you get from this what I wish I would have gotten 20 years ago. And so a little bit about my background. I was a CEO of a large retail organization for 6 of my last 30 years. I worked for in retail for about 30 years, but was always in some kind of management position. Most of my career, I was in a D-suite or C-suite position. And my lovely wife and myself decided we wanted to get out of the corporate rat race and move to beautiful, right now, sunny Utah from Hawaii, where I lived all my life. And we were fortunate enough to be able to meet the lovely team that we have here today, create relationships and be able to invest and grow our wealth together. And we're here to kind of hopefully bring you guys along on the journey. So who's next, Sasha? I think you're next.
Oh, for me, okay. Aloha, everybody. My name is Sasha Smith, and I live on the beautiful island of Maui in Hawaii. Prior to becoming a real estate investor, I was a licensed civil engineer for 10 years, working full time, started my own residential portfolio, started fixing and flipping, but really wanted a more passive way to invest, have my money working harder for me than the other way around. And I felt like when I left my engineering job, I was working 60 to 70-hour weeks. But as an active investor and flipper, I was then put into another job where I was working 60 to 70-hour weeks. So I got into large commercial real estate investments in 2022. And from there, I've done several projects with many partners in this company. And we've built quite a fund that helps other people do more of what they enjoy and have more options in life. So our mission is to build wealth while making an impact, and we're excited to be on this journey with you. So next up, we'll have Emma introduce herself as well.
Yeah, nice to meet everybody. My daughter just texted that she landed in Maui, so that's my temporary connection to it. But we're living in Alaska right now. We retired early. My husband was 48, I was 46, and originally we got into real estate because my husband was an IT guy, corporate startup type of IT guy, and I was always like the side hustle queen, making extra money so that we could afford vacations and things like that. So I started getting into real estate investing as a way for me to stay busy while he was at work, and so I could have something that I realized within the first probably year after I started getting really serious about investing, that it wasn't just going to be a side hustle. It could actually retire him from his job. And he had told me at the time when I started to talk about this, he would say, like, I don't want to retire from my job just so that you can have a job, because I was trying to scale the multifamily business. And I realized it was just going to turn into what you said, Sasha. You know, you're working 50, 60 hours a week for yourself in your own business. That's not financial freedom. And so I had to rethink my business and start focusing on more passive sources of income. and be able to stop purchasing large commercial properties, because that takes a lot of management. And I didn't want to scale that business. We decided that we were going to retire early and had to redo how we were investing and focusing more on cash flow, reliable cash flow. So cash flow management, when you don't have a regular paycheck, becomes something that you need to think about. And so we started redoing the way we were doing our portfolio a couple of years ago, retired early, and now we travel full time.
Awesome. Well, thanks, Emma, for introducing herself and talking about that. But let's also move to Troy Powell, who is her husband.
Hi, everybody. My name is Troy Powell. I kind of run the back end of things. I'm Director of Operations here at Retoro Capital Investments. Like Emma said, we are a team. We work together, and we surround ourselves with other people that are professional and that are also amazing as well. And so we're into understanding what passive income looks like for us, and we started this company to make passive income available to everybody. So we're excited to be here and to share with you what we have.
Thanks, Troy. I think what's integral too about this team is we all bring different aspects to the team, and without the back end of things running smoothly, it's very difficult to get things done. So with that, we'll move to our Director of Investor Relations, Harmony Borden.
Thank you. Like my husband said, we left Maui a few years ago. Prior to coming here, unlike my husband, trying to get out of the rat race of the corporate world, I loved what I did. I was in the medical field for 10 years. And then after that, I did casework within the military for 13 years, where I managed the back home in the state of Hawaii. And I love working with people. It's what I love to do, trying to help them understand their own passions, their own whys. And that's always been something that I've been a part of with the kids and the community, always volunteering. And I'm really big on having my people, my circle, aligning with who I am and what I believe in. And that's what I love about our group, is we definitely all bring something different to the table, but at the end of the day, we really align well. So thank you.
Thanks, Harmony. Last but not least, the newest member of our team. Let's welcome Lisa Moore.
Thank you, Zasha. So yes, my name is Lisa Moore. Very excited to be a part of this team. My background, I was a financial analyst for over 15 years, working mostly in the manufacturing industry, doing a lot of budgeting and forecasting, analyzing things like that. I didn't hate my job, but I knew it was never going to give me the lifestyle that I wanted. And I grew up in Massachusetts, and I moved to Utah in 2016, and knew I wanted to get into real estate. I didn't know what that was going to look like exactly, but I knew that I wanted to buy a house hack it, got started that way, got addicted to that. For that was fairly easy income, and met my husband, and we started house hacking. We've house hacked several properties. We've done a lot of live-in remodels in construction zones. And like most people, I think everyone on this, we got to the point where we were grateful that we did what we did, and it got us to where we are now. And I was able to retire in my mid-30s from the corporate world, and focus just on real estate. And we've been pivoting to do more passive investing, having that time freedom to really look at what we wanted to do and where we wanted to spend our time. The passive route and being a part of this fund really matches with what our goals are, what our financial goals are, and most of all, the lifestyle. I'm very lifestyle driven and focused, and educating people is definitely my passion. Having a background in finance, I didn't realize how valuable that was until I really kind of got out there and got out of being surrounded by other finance people. It's not something that's taught very well in schools, so I'm very passionate about teaching people about finances, personal finances, and making sure they understand what their options are for their retirement, and that they can achieve the lifestyle that they want, and get involved in some investments that can help and benefit them. So I'm very excited to be here and be educating everyone this evening.
Thank you. So this is who you'll be working with on the Retoro Capital Management team. And just a quick disclosure for you guys. This presentation is confidential information only. It's intended for accredited investors under Rule 506C of Regulation D of the Securities Act. And it's not a solicitation of an offer to buy securities. Every investment is subject to risk and uncertain outcomes, which rely on forward-looking predictions. And it's crucial that you guys conduct your own research and analysis before making any investment decisions. We're not investment or financial advisors, so we strongly recommend you consulting with licensed professionals regarding any tax, legal, financial, or business advice before making investment decisions. So just had to quickly go over that. And now we'll go over some of what we do here at our fund and what we can offer. So we are a private real estate fund. We offer higher returns, less risk, giving back. We'll dive deeper into that into the slides to come. And we provide debt and equity diversification, cash flow, and just different growth options, because I think, you know, in anything in life, you shouldn't have all your eggs in one basket. You should definitely be spread out so that whenever something happens, you know, you're more protected because you have different types of investments. So that's essentially what we're going to go over today as well.
All right, so why Toro Capital? As Zasha was saying, you don't want to have all your eggs in one basket. Diversification is very important. You know, a lot of people predominantly invest in the stock market, which at times can be really good. And when it's down and not doing well, and everyone's 100% of your retirement is sitting in the stock market, that can cause a lot of stress to people. So having some investments and being able to diversify your portfolio is just really, really crucial. That is definitely something that is very, very talked about. It is not a new concept by any means. So for us, you know, our returns, we do the debt and equity, as Zasha had said. And on the debt side, we aim for 10 to 12% of investor payout on our private loans. We'll get a little more into exactly what those loans are further down. And then on the equity side, that can vary pending what we're investing in, but we work with experienced operators to make sure that our money and your money is protected. Minimizing risk is a high priority for us. So we, again, looking at diversification, working with experienced operators. On the debt stuff, we are first lien position. And we're very big on giving back. Chris and Harmony have started a charity in Africa, and everyone on here is involved in some sort of giving back and being involved, whether it's in our community or giving back our time to help and educate people. We're very passionate in that way to be a part of helping other people, whether that's locally or abroad. So that is something that we are very proud of and always like to mention. So a little bit about the fund and the customizable. So it's a $15 million fund. To invest with us is a $50,000 minimum, but the minimum per deal is $10,000. So if we have several deals available, you can split that and spread that among different investments. We focus, depending on what it is, debt or equity. As I said, I'm located in Salt Lake City as well as several of my partners. So we invest here, Idaho, Texas, Hawaii, and then some other select states, depending what the deal is. When we're looking at the residential and commercial acquisition and renovation loans, we will go up to 70% loan to after repair value, the ARV. As I mentioned before, first lien collateral. So that means, for those that don't know, if there is a loan, we are the first ones to get paid off. If something happens, we are first in line to get paid. So we don't do second position, meaning there's somebody ahead of us where if something happens or when it gets sold or whatever the exit plan is, there's nobody ahead of us. We are in first position. So that just gives extra security, extra safety. So if something does happen, we're the first ones to be able to get paid back on that. On the commercial equity, We can invest up to 20% of our fund assets under management. And we look into multifamily, RV and mobile home parks, industrial and triple net. We like to have a variety of different investments, back to the diversifying and making sure that we have a well-rounded portfolio. It's always a good time to buy a good deal. Different niches though will have different cycles. So pending the location and what the niche is, there could be a better time to buy certain assets in certain areas. So the fact that we can invest in multiple gives us that option to make sure that we are providing a good selection of investments that are going to fit with the market at the time and the returns that we're looking for. So and again, touched on some of this already, but for the short term on the debt side of things, if you invest up to $200,000, so the $50,000 to $199,000, it's a 10% return. Over $200,000, it's a 12%. So we charge our lenders 12%. And if you are investing $200,000 or more, you get that full 12%. The diversification, we'll do fix and flips. We do development, again, first lien position, making sure that we are the first ones to get paid and in the best position that we can be. These are managed in-house. And for these, we are typically lending, as I said, in the Utah, Idaho, Hawaii area, places where we have boots on the ground. So I know Chris has his GC license. My husband is a GC, has been for 20 years. So if something happened unforeseeable with one of our borrowers, we could step in and help. We could step in and make sure that this deal still goes through. Obviously, we make sure that we vet our borrowers and anyone we work with. But that is kind of our safety net if something unforeseeable happens. And the time frame on these is typically a shorter time frame, 6 to 18 months. It could be shorter. Some fix and flips or rehabs can potentially be a few months, but that's kind of the average that we'll see with these debt deals. And the 18 months, those are typically going to be probably more of a development type deal. Most of the fix and flips shouldn't be taking 18 months. If they are, there's probably something going wrong with those ones. So on the equity side, these returns are just a ballpark. This is kind of what we aim for. Obviously, every single investment is going to be different. The returns are going to be different. There's a lot of variables, but this is when we're looking at deals, what we're looking to make sure the returns are going to be. So 12 to 18% if you're investing $50,000 to $199,000, 15 to 20%, $200,000 or more. Again, as I mentioned, multifamily, industrial, RV parks is what we are looking. And for the management, we are partnering with high-performing operators. We are making sure that these operators know what they're doing, are seasoned, have had multiple deals, have done exits. Everyone on this team, which is one of the reasons I loved this team. I've worked with some of them outside of this fund, but everyone in this fund, we've all owned, we've all managed, we all know what it takes, which is why we want to be passive. We've all done it, so we know how to vet operators, we know what to ask for, we know what to look for. I think that's very important that all of us have that experience. All of us have done it. So being able to talk to operators and know what we're looking for and what makes a good operator is crucial. And most of those equity deals, you're looking at 3 to 7 years. That's the average. Really, any equity deal that you're looking at, whether it's with us or somebody else, it's going to be in that 3 to 7 year range. Could be shorter, could be more, but that's always the ballpark range that most equity deals are going to be in. So, all right. So for the residential, again, the debt side of things, high sales area, fast turnover. This is a good preservation of capital, getting good returns that are fairly safe, first lien position, backed by an actual asset. Gives that diversification and more stable returns. With the debt, you're getting that set payment, you're getting that set amount from that loan. So that is why we like that debt side. It gives a more steady cash flow and gives us more stable returns to us and to our investors. And then again, on the commercial, we're looking for high demand locations. We're looking for locations that are showing growth, that have job growth, that have population growth, income growth, and a diversified job market. So we want to make sure that wherever we're investing is going to be a good market, is going to continue to be a good market, and make sure it's a good hedge against inflation. And again, some of these longer term, 36 to 60 months to 3 to 7 years, and higher growth. So for these, we're looking to get a higher return, that 15 to 25% IRR over that time frame.
All right. So one of the things that we do to make sure that we are focusing on our 3 core missions that we're prioritizing at Rotora, we've got higher returns with less risk, so that we can enable ourselves and our investors to be able to give back to their communities. So as we're balancing those higher returns with that lower risk, one of the things that we're going to look at is the target market statistics that we really need to focus on to make sure that the investment is going to perform above average, and also to make sure that we are not adding too much risk to the deal. So the market's very important. The first thing that's most important to us is it's a market that we really understand, because as you know, markets can be very spotty. That takes local knowledge, and it takes understanding, like boots on the ground, to know exactly what's going on, because you could change, like the house across the street could be in a different school district or a different flood zone. You just never really know what you're getting into when you are not a market specialist. So markets where we spend a lot of time, where we live, or where we own other properties, and we're traveling to frequently, is one of our most important criteria. But it wouldn't be the most important if the market itself was no good. So we do look at these other statistics to make sure that the market that we're investing in is going to deliver consistently with less risk. So the steady population growth has to be a large enough town that we can easily source labor, materials. That's a big deal. Sometimes you'll see a great deal in a very small town, but then you can't really service the deal because there's not enough population to get the support that you need from management and the renovations. So positive net migration, meaning there are people moving in, not people moving out. You can't just take a big city if it's shrinking. We want to see employment growth, that people are moving to the city for better opportunities. There has to be some economic diversity there. You can't have one major employer that's employing any more than, say, 20% of the workforce. We want to see that if one industry goes down, that there are others to be able to prop it up. And we saw that same thing, especially during the pandemic, when towns that were very reliant on, say, colleges or on some tourism, that those industries really suffered, and the investments in those areas may have suffered along with it because it didn't have enough diversification in the employment base. So positive absorption rate means that more units are being rented up than are becoming vacant. So we want to see that if there's something new under construction, or if there's new product being brought onto the market, that absorption rate is high enough to be able to absorb all the units, not just ours, because we want to make sure that we're not too competitive, that there is some housing constraint, meaning that we're going to have an easier time either selling or leasing up, depending on which strategy we're using. Low crime rates, very important, and that can be also very pockety. The crime rate here could be very different than the crime rate a few blocks away. So just making sure that we're very familiar with what exactly is going on in the town, the best areas of town, and schools and crime. And we need to see a strong tenant demand. Again, that's all being shown through these other metrics, but we also want to rank how much the tenants are moving into this particular property. What is their current occupancy? What is the demand going forward? So we need to see that the demographics are the type of person that's going to be renting. So say that it's something that is going to attract like a young professional versus somebody who's more on the retired side, and we have assets that specialize in different demographics. So we need to see that those demographics in that area are matching up with the asset. I'll give you an example. We have an RV park that is mostly targeted to retired people, but that works in that area because that area attracts people who are near or at retirement. Whereas the strategy might not work if it was an RV park in that same area that was targeted towards young professionals, because they're not going to be living in an RV park and they're not going to be living in that town. So just making sure that the product location matches the people who are going to be living or working there. So we need to make sure also the mortgage to rent spread. If somebody can buy a house for the same amount or close to the same amount that they can rent, they're going to be less likely to be long-term renters. So we want to make sure that the average home price is kind of high compared to the average rent price. Then obviously favorable regulations, like anything can get shut down if the regulations are not suitable, like we saw with the eviction moratoriums that are now being challenged in court. We have situations where a city may be very easy to work with on permits and other cities that are very difficult. Changing regulations, we want to make sure that we're in a business friendly area. And again, if we're combining all of these, any one of these might be able to be not fantastic. Like you're going to have a scatter plot where some things are going to be very strong and others are going to be weak. But what we're trying to do is get as many as we can into the strong area so that they're not going to take down a project if they have a few of these that might be on the weaker side, because it's always going to be a trade-off. And that's why the target markets that we choose have as many of these are strong as possible. That's why we focus on Salt Lake City, Texas, as certain markets in the Southeast are where we spend most of our personal time and most of our investing efforts. And so these are our investment principles. It's important that you understand where we're coming from as a potential investor, like what our principles are, to make sure that we're aligning not just on the way that we invest and the places we invest, but also the values that we bring into the company. So we're looking for a very experienced sponsor. If we are in-house managing, like we do on our private loans on residential, we want you to understand like our experience level, what we're doing to be able to manage that asset on your behalf. And if we're investing with another group of people, like large commercial multifamily, and we are not the primary sponsors, but because we have managed, owned, and operated, like Lisa was saying, it makes us better able to identify what's important in a management team, because sometimes you can get a little bit lost in the marketing sizzle of a particular group and not understand the important questions to ask to see if they're going to be able to take care of that asset, if they're going to be able to take care of your investment dollars. So our experience managing these things helps us to better identify people who are there to get the job done versus people who are there to just talk about getting the job done, if that makes sense. So again, we're focusing on strong sponsors, strong markets. The asset itself has to be strong. We're going to look at first the overall area, the neighborhood, and then down to the deal itself. So we like value add, we like some new development, we like class B, maybe high C would be our favorite. We do look at some luxury, and we do look at some class C, but our favorites like that mid to low class B. And with high growth potential, we want to make sure that people are flocking to that particular asset. And we also want to make sure it's easy to manage. Some properties are very hungry because they just need a lot of work. And so it seems like every time you turn around, it needs another repair. And so we want to make sure that these assets that are places that people are proud to live and that also are easier to maintain. So usually either the newer ones or the ones that are completely remodeled are the ones that we prefer. And if we're going to take it over when it's less than ideal, we want to make sure that that business plan is getting it to that point where it's going to be easy to take care of for the long term. We know that things need turned every 10-ish years or so, just based on fashion, like the flooring and the cabinet the colors and styles change. So about every 10 years is what we think of as a cosmetic overhaul. And then some of those things that are more of the 20, 30 years, like roof, siding, pavement, we want to make sure that those are going to be good for the long term, and that they're not just going to keep costing us money down the road. And then the financial, that is what will make or break a deal. We have to make sure that the financial model, meaning if there's senior debt on it. So sometimes we're lending and we are the senior debt providers, but if we're putting equity in, that means there's a loan on that property. And so we need to make sure that not only the loan on the property is sound, that the interest rate is going to be something that the property can handle, that we can throw curveballs at the property and it could still perform. Commercial loans will not last for 30 years like residential ones do. So we need to make sure that with the shorter time frame that commercial loans have, that the property can withstand those loan constraints the entire time we're going to own it, plus a little bit more, because sometimes you want to sell it, and for whatever reason the market, you have to wait. So it makes it really important that the financial structure of the loan on the property makes sense. And then in addition to that, our financials that we're going to provide for you is going to make things a lot more convenient, because you can invest in any one of our deals in our fund, all of them, just one. It's really up to you how you kind of build your own portfolio there. You have a lot of customization, but we will give you a single K1 at the end of the year for every deal that you invest in. And that makes it a lot easier for you and your tax professional to be able to get a lot of diversification without adding layers of complexity to your portfolio. It's kind of a one-stop shop when you think about it that way. And so you can also choose if you're going to reinvest your returns and let those compound. Our goal is when you're having a debt investment that you will be earning 10 or 12% on that. But if you were to compound that over 5 years, if you're going to be able to achieve, say, a 15% IRR by not pulling those gains out, that our equity investments will outperform that. So if you are increasing the illiquidity time of an investment by saying, oh, I'm going to put money in for 5 years, it needs to outperform the debt, which is more liquid and less risky. And so what you're going to see is we're only going to go after the financials on an equity deal that can outperform the lending over the same time period of, say, for example, 5 years. So we'll talk a little bit more about compounding. That's a big part of what we do to make sure that we're comparing more apples to apples on IRR. So that 10 to 12% is an APR, an annual interest rate. But if you reinvest those gains in compounding, you can start to match the returns that you're going to see that are in the 14, 15% plus. And so any equity investment that we bring in will have to outperform that. So that's a core part of what we are doing at Retora, is balancing that return with that risk level and that liquidity level of flexibility. All right, last for me is the tax benefits. This is really important because everybody is in a different tax situation. So Troy and I are real estate professionals, which means that we get a lot of tax benefits that most people are not going to be able to enjoy. And so that's just one example of where the situation may be drastically different for one family than it is for your family. So we're just going to keep this high level that's going to apply to people in general. And we want to talk about how you can plan ahead for your taxes. People hear that real estate is great to help you defer taxes, but there are certain ways that can be done and certain ways that can't be done. So it's important to be educated. So some of the tax benefits of investing with us is that you get to keep more of what you earn. If you are able to earn more so that you can pay the tax bill, that is one way that you can kind of look at that as a way of saying, okay, well, I'm getting taxed on this, but if I'm earning more passively over here on the side, that you can use that extra that you're making to pay a tax bill if you have a W-2, especially if both of you are W-2 employees, and getting a lot of tax that way. Just being able to earn more passively to pay that tax bill is one way that you can benefit from this. The other is to use a self-directed IRA. This is especially important if you are earning interest on a loan, because the interest income is taxed as active income versus passive income. So rents would be passive, interest income would be active. I don't understand it, but that's how the IRS treats it. You also have the option that if you want to reinvest, or you want to invest in a project that's more long-term, that you can offset or defer your capital gains. So lots of options here. And that's why it's customizable, because not every deal is going to suit every single person, because not only do you have different lifestyle and income expectations, but you have a different tax situation. And so this allows you to pick and choose based on what you and your tax advisor think that you need for that particular tax year and plan ahead that way. And then you can cycle through those investments for consistent income. That's what we do. We like the reliable income that comes from the debt investments where we're private lenders. And then we also like to do a little bit of growth in the longer term for depreciation so that we can write that off of our active income as real estate professionals. You can also carry over your passive losses indefinitely. And then every time you have a capital gain, you can then use that to back into offsetting that loss. Lots of options here. So just make sure that you understand what your particular tax situation is. And then if it's complicated, working with a professional who can help reach your goals. And I think that it's also important to note, we've done content on this before, making sure that your professionals are experts in the things that you want to invest in. Because sometimes you'll run up against something where they don't understand it, or it's not something they sell. And just to make sure that you're aligned with your professional, to make sure that you're both going down the same path and that they're giving you advice that's really relevant to you, versus steering you away from things just because they don't understand it or sell it. So paying attention and making sure that your professionals align with your goals is really important. All right, who's next? Hey, Chris. You're on mute.
Sorry.
There you go.
That would be me. Thank you, Emma, for all that wonderful information. I think ultimately, because the question actually came up in the chat, and I kind of want to bring that question back up. So the question came up: is anyone utilizing barbell strategy for portfolio allocation? I mean, I think in general, we're strong proponents of, again, for diversification, just in general. The fund in general is set up specifically for diversification. You kind of go back, and it's somewhat of a selfish reason why we set it up that way, because all of us are at the point where like we all stepped away from our W-2s. We talked about it in the beginning. Every single one of us had a W-2 at one point. We all stepped away from them. We have some varying degrees of motivating factors to want to continue. I think the biggest for myself and my wife is kind of a push forward, and Lisa mentioned it earlier, more for general education and trying to get more education out there. Lisa talked about our philanthropy work that we do, and a lot of it is based around education, just trying to bring more opportunities, wealth growing opportunities out there. It's things that we did not learn when we were growing up, and we were I think a lot of us, especially in my generation, we were brought up to go to college, do real well in school, go to college, and get a good job, work really hard, and retire at age 65. And hopefully you have enough in your retirement, go find a really good financial advisor, and go from that point on. So the context of a lot of things that we're talking about is in context to basically diversify. So now how everybody diversifies, I don't think there's one strategy that should be built over another strategy. It kind of depends more on where each individual person is at their phase in life, and then money should be predicated off of exactly where you're at. And obviously, Emma talked about compounding. The compounding side of things is, and I think it's on my next slide. The earlier you start, the better it is you're going to be. I mean, the compounding effect. You just look up. Everyone knows Warren Buffett. Look at Warren Buffett's wealth growth chart. You see it's astronomical. It's very, very, very small gains for the first 40, 50 years, and then just astronomical gains in the last decade of his life. It is outrageously astronomical. So again, going back, diversification is huge, and a big part of our diversification is lending. So I want to spend just a little bit more time going over the debt side of it. Probably 80% of our portfolio that we look at is debt. On my personal side, almost 70% of everything I invest in is debt. Again, it's looking at, doing that, not necessarily a barbell strategy, but we definitely have allocations of funds. Myself and my wife personally have allocations of funds spread out through both debt, equity, and more emerging markets, venture capital type deals. But because of where we're at in our lives, we want a larger portion in the debt side of it, and slightly less on the equity, and even less on the more higher risk ventures. So we're looking at that. Debt is super important. So what we're going to, and everyone talked about it. Lisa talked about it a lot. The types of assets that we go after. The biggest thing to kind of understand is this: the cash flow is significantly higher. Your cash and cash returns are going to be, well, it says 9 to 12%, but it's going to be in excess of 10%, because the short-term loans that we do, again, Lisa talked about debt being 16 to 18 months. Our terms are only 6 months. All of our terms that we initiate are 6 months for residential fix and flip, and 9 months for a brand new build. If it goes over that point, we'll normally renegotiate that loan, and then you get that compounding effect that much faster. So when we're looking at it, you have a high proportion of your money. So again, if you're in the phase that we're in, and a lot of people are in, where they're investing, they have a large portion allocated in debt. You look at it and compare it to, if I was in the equity markets, again, a typical 60-40 portfolio, on the 40% of my portfolio, I'm earning somewhere between 2.5% to 4%. This is comparative. The debt that we're looking at is comparative. I mean, you're going to take on slightly higher risk with these residential debts than you would on the treasury, because the 10-year treasury is literally the risk-free rate of return. So, but you're looking at it, but the way we're aggregating our debt and the way we're allocating money to debt, we are very conservative just in general. The one big thing to know that probably differentiates ourselves from, I would say, 95% of the different funds and fund managers you have out there is the reason why we created the fund. The biggest reason why we created the fund is we wanted to invest our own capital, and this is how we wanted to invest our capital. So you'll see our capital invested in majority of the investments that we have. There's a few times where investors honestly want to take the entire investment, and we're not going to argue with that either. But the biggest reason we invest is, we started the funnel so that we could get our money invested. And this is exactly how we wanted to invest our money. Lisa talked a little bit briefly about first lien position. So all of our loans are collateralized in first lien position. I'll go over the capital stack so you understand a bit more, but that's the lowest risk profile you're going to have when you're looking at real estate debt investments. I've kind of talked about this, but on the debt side of things, again, I'm comparing it back to the portfolio. So again, your typical 60-40 portfolio, which is the typical, I think it's the highest utilized portfolio within the equity markets, within market money managers. But when I'm looking at it, again, I'm comparing what I can earn from your typical money market. And again, a 10-year treasury is very high now. It's historically at its high. So, and it's, I haven't checked for the last several weeks, but somewhere around 4.2, 4.3%. Now, if I can get something relative, and I think I have a graph that shows like Sharpe ratio and different standard deviation, but if I can get something relative, collateralized against a physical property, and earn 2 to 3 times the amount that I can earn from the 10-year treasury, why in the world would you not do it? I for the life of me, can't understand why more people are not doing this, especially utilizing vehicles like Emma talked about with your self-directed or an IRA that you can. If you have an IRA, you can definitely convert it to a self-directed IRA and invest in different alternative assets. This would be one of the assets that you would be able to invest in. Just quick backstory, my wife and I, before getting full-time into real estate, we had a financial advisor. We had a financial planner that was a really nice guy that we used for almost 15 years. I think it was just shy of 15 years. And when we went back and looked at our overall annualized compounded net return over the 15 years, it was barely above 5%. And I know I can get pretty consistent 10 with it's going to be in excess of 10 to 12% on the private loans. So again, I'm expediting my overall portfolio growth 2 to 3 times what I would be earning if I was just with a normal financial advisor and money market manager. So here are the fund return profiles that I talked about earlier. So these are our target profiles, and everything changes, right? I would say the one benefit about having a customizable fund the way we have it is literally that it's customizable. We get to decide and bring in the assets, and along with our investors, they help us decide what kind of assets they want to look at. But all assets are cyclical. They perform differently in different markets. A good example would be if the market starts to go bad, and we're starting to go through a downturn like we've seen in 2008. You start to have more pressure, and we're having more pressure on multifamily assets as we look at right now. Typically, in that same environment, you're going to have an increase in storage units, just simply because people are moving out. They're going to have to condense. You have an influx of storage units. So you don't necessarily want to have, I think Zasha mentioned this, you don't necessarily want to have all your eggs in one basket. And we want to be able to pivot where we can pivot. But ultimately, these are the type of return profiles we'd be looking at. Currently, the bulk of our investments are in debt. So I would say currently about 80% of our portfolio, maybe even slightly higher, is allocated towards debt investing. But we are always actively looking for multifamily assets, storage assets, triple net assets, development, triple net industrial. So these are the types of assets that we're interested in. We've already invested in within the past, and we want to continue to invest in going forward. We are looking at these types of investments as kind of like the cornerstone to a good diversification. I think it was Emma that talked about the market, getting good market diversification. So we're not condensed all of our investments into one specific market. We don't have all of our investments into one specific asset, but we have a nice even allocation between all of our assets as well as all of our funds. Now, we're going through the different, I'm not going to go through all of them, but you can clearly see the different preferred return that we're looking for, the different cash on cash that we're looking for, depending on the asset, and the different targeted IRRs that we're looking for between each one of the assets. I think that the important thing to point out on the loans is the overall targeted IRR is anywhere between 10.5 to 12.5, with an average IRR of about 11.5. So again, the bulk of our portfolio is that, so I just definitely wanted to call that out. Now, going back to the question on the barbell strategy, we look at it as far as, okay, the risk profile that we're taking on and how we're allocating assets based off of that risk profile. So there's two different risk profiles that we look at here. Standard deviation, I'm not going to go through the exact calculation of it, but it's just basically the ebbs and flows of the particular asset over time. And then we also look at the Sharpe ratios. One of the things that we look at as far as it's not something that we actively look at for every single asset, but when we're articulating the assets that we want to look at, and when we're putting together portfolio allocation, this is one of the things that we look at. So the Sharpe ratio basically tells us what is the return type I'm going to get compared against the risk-free rate, which I already told you was a 10-year treasury, and comparing that to the standard deviation for that particular asset. So again, the higher the number, the more safe that asset is versus the return you're going to get. So again, one of the things that we look at, I don't have it on here, but we also look at risk premium. So when we're looking at the assets, kind of based off of that targeted IRR, what is the risk that I'm taking on versus the amount of return that we're going to get? And you want to be able to have a good allocation of all of them just so you can have a standard portfolio. Again, going back to Warren Buffett's rule, right? Number one rule is never lose. So if you have an 70 to 80% allocation in debt, and it is very, very hard to lose on debt. It's possible, but it's very hard to lose on debt. It's very hard to lose everything. The world would literally have to end for you to lose everything because we are in first lien position. Now, not all debt is equal too. Just remember that there's different debts that can go in different positions. There's debt that's not allocated against anything. There's debt that corporate bonds is a debt, but it's leveraged against the actual business. So debt profiles are not all the same. Debt allocations are not the same. And risk to return ratio is not the same depending on the assets that you're looking at, or the debt that you're looking at, or the assets that you're looking at. So just get yourself educated when you're looking at it. I don't think there's one strategy that will work for everyone. I mean, all you can do is you just look up the most famous investors out there, and they all have different return profiles. They all have different investment, theologies on exactly how they wanted to invest. So you have to do what's more comfortable for you, but the biggest thing is educating yourself. Real quick, just going over the capital stack we talked about before. The biggest thing to understand is for our debt, we only go into first position, which is the lowest risk profile that you have. This is mirrored typically around commercial real estate, because in residential real estate, you typically only have one or two lien positions on there. And then the rest of it would be the construction liens. This is a typical capital stack or lien for a lien stack for a commercial resident. and you're looking at the highest risk versus the lowest risk. And typically your return profiles will be higher. Again, the risk premium that I talked about earlier, your return profiles will be higher depending on the position you sit in. Again, for debt, we're taking on the lowest risk, which is a larger allocation of our portfolio.
Thank you. So now we're going to take a look at our portfolio here within the fund. We are diversified by design. We have gone full cycle. I know on here it says 50, but now we're over 60 short-term debt acquisitions for loan renovations. We have short-term commercial loans on assets like storage facilities, small multifamily. We've done some rezoning. That's just within the fund. Outside the fund, like they've mentioned, every single one of our partners here have multiple investments and projects outside of the fund. So the experience levels here add up, and there's just so much to offer. They mentioned earlier with Chris and Lisa's husband both being contractors. Lisa and I are both licensed real estate agents. So adding a little bit more behind that comfort level for our debt investing is definitely a plus here. But we like to be as diverse as we can be with being as secure as we can be. Am I supposed to click next slide? Sorry. Giving back. Lisa mentioned it earlier. This is a part of why I love what we do. I didn't mention before, I did love doing my career before with the military and casework. I love working with people. My husband pointed out, but now you get to help on a different level. And that has also opened it up to where I can help on a larger level. So helping people is huge. And the fact that we get to do this from anywhere we are, and being able to do it with those we align with, having that freedom to do it makes me even more passionate about this and being able to make an impact more. All of our partners, I think Lisa mentioned, are already involved in a lot, whether it's raising money for foster care, whether it's creating affordable housing, volunteering time to go and help others, or creating, trying to help in economic growth in other countries. Just aligning ourselves with individuals is huge, and being able to align ourselves with folks out there who want to give back, and you don't have the time, you don't have maybe the resources in the moment, but here, if we can, let's try to help you give back with some of your returns. We can definitely look into that. And if it's a nonprofit that has its 506c3, then you definitely can. But partnering with those who align with you is definitely huge, not just because we're the professionals in this, what we're doing, but because you also get to give back or support in that in some way. Choosing your own investments. In our portal, you'll get to see that you get to choose whatever you want. You can be as passive as you want as well. If you want to be more passive and say, hey, you guys, I want you to choose my deals for me. When it's our debt deals, you can do that all day long. We'll just send you the document, you commit to it and sign it, and we'll keep your money working for you. And we always say, we want your money to work just as hard or harder than you do. So let your money work without having to worry about it. Or you can go in there and pick and choose. I think Lisa mentioned it earlier. You can take a portion of it and allocate it to different deals. On our equity, you definitely want and should want to be a part of those decisions. And you have to be a part of those decisions on letting us know what you want to allocate your funds towards when it comes to our equity. But it's as simple as signing a quick document electronically, and getting the opportunity to be in any of these deals is going to be big, and aligning yourself with what you believe in and where your money's going with a group that you align with. Great. It's going to be a great experience.
All right, so to just kind of summarize things real quick, going along the same lines that Harmony had just mentioned, we're really focused on helping out other communities, looking for opportunities to serve others through providing affordable housing, but also looking for opportunities to go out and serve just in general. In fact, we do employ a number of VAs that are over in Africa and Cote d'Ivoire that that help us with our day-to-day operations, and they've been invaluable in their efforts in helping us to help everybody else. Our focus is trying to we're looking for opportunities to make an impact worldwide. We'll try to make sure that we focus on the environmental impact and the investment in our investment portfolio to make sure that we are indeed making a difference in the not only in our investors our portfolios, but in the world in general. We try to ensure that we are focused, we stay focused on the cultures of the areas that we're investing in and the needs of those communities, and our investments that are, like Emma had mentioned before, that are focusing on areas that maybe have a higher crime rate than others. We look to try and invert that crime rate so that it becomes a place where people want to be rather than shying away from it. So our leadership, as Harmony had mentioned, and as you've heard from the rest of the group team there, we have experience not only with the team together, but we also have a lot of experience prior to getting together as a team. The thing that brought us all together is the singular mindset that we had about trying to help others to break out of the rat race, I guess you could say, and to look for more opportunities for philanthropic opportunities where they can help other people as they help their own portfolios grow. Because we believe that people in general, as they meet those basic needs that everyone has, that they will start to reach out to other people and try to understand the needs that other people are that are missing, and find a way to fill those needs. So please feel free to reach out to our team. Again, we're Retoro Capital Investments. We look for an opportunity to work with you and to try and help free you up so that you have more opportunities to serve not only one another, but serve in causes that you feel strongly about, whether that's traveling overseas and helping the other people in need, or in your own neighborhoods and helping your community, or just pursuing the passions that you've been putting off all of your life because you haven't had the opportunity or the means to be able to pursue those yourselves. So again, this is Rice Capital, or sorry, Retoro Capital Investments. I'll have to edit that later. So please reach out to us, and if we can't help you, we will be able to find somebody that can. We have a lot of connections in the industry, and we can help point you in the right direction of where you can best achieve your own goals. So thank you again for joining us today.
Thank you.
Aloha.
Uyo.
I don't know if Chris, if you're muted, if you're trying to share your words of wisdom.
It wasn't too wise though. It's just, that's the one thing with coming on live. Like, you have Freudian slips that we just edit out later, but it's live. Yep. So those of you who are joining us live, you get to see the Freudian slips. So yeah. So I appreciate everybody coming on. Those of you guys that joined from outside. Again, it's a team where our values, and the biggest reason we got together is our values align. Our goal out there is to be able to take you guys along with the journey and invest alongside us, and hopefully make the world a little bit better place through a lot of the philanthropy work that we do, and somehow have fun along the way. We're still trying to figure that part out, though.
We have fun.
We have fun.
We live in Hawaii and Alaska. We got it.
All right, guys. You guys all have a great night. Aloha and ohuyo.
Aloha and ohuyo.